This video will take you through what the auditor does to identify and then communicate internal control deficiencies to the client. We will need to cover the following: how the auditor identifies deficiencies, the management report, and the timing of communicating deficiencies. When performing the audit work, auditors must review the control systems that relate to the financial statements. These can include the following systems: sales, purchases, inventory, payroll, cash and bank, and non-current assets. Each system must be reviewed and understood by the auditor. They then document the system for their own evidence and begin the task of deciding whether the system could cause potential material misstatements. As they are performing this work and testing the systems, they will identify if there are any issues with the way the system operates. Using their skills and experience, they may notice control activities missing within the system that could cause problems. Time taken to understand the system, review documentation, and use internal control questionnaires gives the auditor the opportunity to find deficiencies within the system under review. Here are some examples to help you understand what is meant by deficiencies. For a sales system, the auditor may discover that discounts for customers are manually input onto the face of the invoice by the sales clerk. The issue here is that the discount may be input incorrectly by the clerk. Human error is always an issue when manual input into a system is present. This could lead to misstatements in the sales and receivables balance. This scenario could also lead to the sales clerk inputting unauthorized, inappropriate discounts onto the invoice. For every control deficiency found, the auditor has an obligation to recommend how the entity could improve that control. A recommendation for the control deficiency that we have just discussed could be to have authorized discounts included on the customer account on the system so the invoice is automatically updated with the correct amount. For a purchase system, a control deficiency could be where the warehouse receiving the goods delivered agree the goods received note to the physical goods and then file a copy of the GRN and send a copy to the accounts department. There is evidence of good controls here as they do review the goods received with the goods received note. However, they do not review the original order to see if the goods received are what was originally requested. The goods may have not been ordered and the entity could be invoiced for goods not required. A recommendation would be for every delivery into the warehouse to agree the goods to the GRN and the purchase order before accepting the goods. For inventory systems, a control deficiency could be that they do not mark inventory when it has been counted during the inventory count. If not marked, the inventory could be counted again or missed altogether and not detected, which could cause a misstatement in the inventory balance. A recommendation would be to mark the areas of the warehouse where counting has been completed. This way it will be clearer to see if areas have been missed or to not count them again. For a payroll system, a control deficiency could be the monthly payroll report is not reviewed. If the balances are not reviewed for each payroll run, there could be a misstatement not detected. The recommendation should be to ensure a responsible official, such as the payroll manager, reviews the payroll report and compares the balances to previous months to identify potential misstatements. Evidence of checking, such as a signature, should be present. For cash and bank, a control deficiency could be that the cash is not banked regularly. If cash is held at the business and builds up, it increases the temptation of theft. A sensible recommendation, therefore, should be to regularly bank money. This task should be undertaken by more than one employee, and rotation of duty should also reduce the risk of fraud and error. In a non-current asset system, a control deficiency could be that the request for a new asset is not approved. If not approved, assets could be ordered for personal use, therefore the risk of fraud is higher. All asset requisitions should be approved by a senior official. Decisions on purchasing of assets should be made with the reference to budgets also. Once the auditor has identified control deficiencies, they will then collate them and include within a report to the management of the entity. This report has various terms associated with it. You may hear it called any of the following: a report to those charged with governance, a management letter, and a management report. The auditor has ISA 265 to give guidance on communicating deficiencies. It tells us that significant deficiencies should be communicated in writing to the entity's management. This is usually prepared in a letter or report format. The management report should be addressed to the directors of the entity. It will detail all of the deficiencies found by the auditor during their audit. They will also explain the impact of the deficiency and a recommendation. The deficiency should be a clear description of what is wrong. The impact should be an explanation of what could happen if the deficiency is not addressed by management. For example, as we've already discussed, deficiencies could lead to theft, errors in the accounts, and unnecessary costs. The recommendation should be a realistic suggestion to improve the specific deficiency. This is to help the client improve its control systems for the future, which will assist future audits if it is then implemented. In addition to outlining deficiencies, the auditor must give specific information regarding the evidence being provided. Within the report, they will explain that the report is not a comprehensive list of all deficiencies. The deficiencies are only those found during the work of the auditor, and there may be more that have not been detected. The report and the information within it is for the sole use of the company. They should not disclose anything within the report to a third party without written permission from the auditor, and no responsibility is assumed to any other parties. The timing of the management report is agreed at the beginning of the audit assignment, before work commences. Management reports are usually given to the client at the end of the audit process, once the audit report has been prepared. Often, the client will have a meeting with the auditors and discuss these deficiencies to enable them to clearly identify what needs to be done. In summary, auditors use their experience and feedback from the client to understand the control systems, and this enables them to identify deficiencies. They are required to identify deficiencies and recommend improvements to control systems, and this is laid out in ISA 265. There are various control systems that relate to the financial statements, including sales, purchases, inventory, payroll, cash, and assets. Once deficiencies are identified, they are included in the management report, along with the impact and recommendations. The management report is usually communicated at the end of the audit, once all of the audit work is complete. I hope you found this video useful. Thanks for watching.